People are still coming in. Okay, so we'll get started. Welcome everyone, and thank you for logging on and attending this evening's program. My name is Matt Schumann. I am on the programming team here at Cary Library. Before we begin, just a few things to note. Please let me know if there are any technical issues that I can try to resolve. You can send those to me in the chat. Any questions or comments you have, we will address at the end, but you can also use the chat to send those. Unfortunately, our closed captioning is not working this evening, so we do apologize for any inconvenience. Otherwise, this program is made possible by the generous donors to the Cary Library Foundation. I'd like to now introduce Innessa Manning. Innessa is a certified financial planner with over 20 years of experience. She graduated from Columbia University and earned an MBA from NYU's Stern School of Business. She currently serves as the president of the Cary Library Foundation, and she is a Lexington resident. So please welcome Innessa.
Thank you very much. Thank you very much, Matt. I'm very excited to be here tonight to talk about this important topic of college savings. And I am particularly delighted to be joined by Sharon Olofsson, who's also in the video screen here. Sharon, give us a little wave. Sharon is the founder of Gateway Educational Consultants, which is an education consulting firm, an advisory firm. And she's worked with a number of Lexington families and students over the years. She has extensive credentials in this area and substantive expertise. She and I have chatted a couple times in preparing for tonight's program, and I have learned a ton already from her. So I'm really excited to be able to bring her to all of you tonight. So the way this is going to work is Sharon is going to speak first. She's going to focus on college selection and college costs. And then I'm going to speak briefly on college savings and investing. And then we'll both come together to answer any questions that you have. So with that, Sharon, I'm going to hand things over to you.
Okay, thanks. Thank you for having me tonight. I am going to go ahead and share my screen now so you guys can see the presentation I put together for tonight. Give me 1 second. Does this look okay? Can you see it?
Yep,
I can
looks
see
good.
it.
Good. All right. So as Innessa said, I am a college consultant. My office is based here in Lexington. My background is actually in finance. I studied finance undergrad at Wharton and then got an MBA in finance. I moved over to the college consulting side after working with university endowments and decided that I needed to help families figure out how to afford college. But like Innessa pointed out, my focus is on the college list, on making your list full of colleges that are affordable to you. Less so on the focus on how do you save for college, but how do we find the right college that you can afford? So with that, we'll get started. What does college cost? I hope you guys are familiar enough to understand that college costs have just skyrocketed, and unfortunately, there seems to be no end in sight. If you look at costs from about, when we went to school, they've almost tripled, and they have far outpaced the increase in inflation and other expensive things like healthcare and housing. So what does college actually cost? Well, the first thing you need to know is what's called the cost of attendance. That is basically the sticker price. Like if you're buying a car, what is the sticker price for the university? So this has a breakdown that starts with tuition and fees, then room and board, and then kind of a catch-all of other. Could be books, personal expenses, travel expenses, sometimes health insurance. All in, UMass Amherst for an in-state student runs about $32,000 a year now. I just put some examples of some out-of-state public universities tend to run around $60,000. Now, again, remember, this is the sticker price. This is not necessarily the end price. We'll get into the details of financial and merit aid in a bit. And then private universities tend to be even higher than that. UChicago has the badge of honor of being the most expensive university in the country at about $80,000 a year. Now, all that is the scary news. There is some good news. If you look down below, about 2/3 of students don't actually pay this price. So 2/3 of students get some kind of discount. Either they get financial aid or they're getting merit aid or a combination of the two. So how do we figure out what a college costs you? we're going to walk through each of these items. Let's start with the first, the expected family contribution. Now, this may be a new term for you guys. This is the amount that the US government thinks your family can afford to pay for college. So if you take a screenshot of this, take a look at this link here, that will give you your quick EFC calculator. This should only take you about 10 minutes to input your information, and it's anonymous. Just you need a few data points from your taxes and get an idea of what the government thinks you can afford to pay. I'll tell you, I've never seen a family that is very happy with their EFC. It tends to be more than you thought you could pay. That's the first number you need to know. Now, the next thing is, how does that compare to the cost of the school? So let's say, I can tell you, for instance, most families that I work with, if in the Lexington area, tend to have a pretty decent income. Their EFC may run about $50,000 or more. That means that the colleges think you can afford to pay $50,000 a year. So the question is, how much need do you have? So the next point here, the demonstrated need, this is taking the cost of attendance. So like we said, UChicago, for instance, runs about $80,000. Let's say your family's EFC was $50,000. So you take that away from the cost of attendance, you have a $30,000 balance. That is your need. That means you need help with that $30,000. So now what? Now, different universities will treat that differently. So the universities with really large endowments tend to meet 100% of need. And that means they will help you with that entire $30,000. Most universities cannot do that. They cannot meet the whole 100% of need, and they will meet a fraction of it. It might be 80%, might be 50%, whatever it is. That's the big part of where we come from making the right college list. Because if you need aid, we want to try to focus on schools that will meet the higher percentage of need. The next question becomes, let's say they meet that need. How are they meeting it? Are they giving you grants or are they giving you loans? Grants, or also known as scholarships, is just free money. And so let's say you have that $30,000 and they're giving it to you as a grant. Now the school really costs you your EFC of $50,000. If on the other hand, they're giving it to you all in loans, not only do you pay it back, you have to pay it back with interest. So that's not necessarily all that helpful. The final point on this slide here, the net price calculator. This means this is how much the college thinks you can afford to pay for them. So it's different from the EFC. The EFC is what the government thinks you can afford. The net price calculator is what that college will cost you. Again, keep in mind, the net price calculator, just like the EFC, is an estimate. So you can do this today and find out what a particular college is supposed to cost you, but you don't know the final price until after your student applies, gets accepted, and then you get an actual letter, an offer letter that will give you the details. Every college website is required by law to have a net price calculator on their website. They are not necessarily required to be accurate, and you'll find that the calculations are very different. Some are much more in depth, in which case often the calculation can be better. Others are kind of a cursory look at your finances. This website here, myintuition.org, is kind of a compilation of many net price calculators together. So rather than kind of running around to a million different websites, you can start there and see if the colleges you're interested in are on that particular website. All right, I've given you a lot so far. Now we're about to get more technical. Let's start with the EFC. Again, this is that same link that we had on the page before of how you get your quick EFC. Basically, the EFC is very, very heavily based on family income. As you see, it takes 47% of the parents' adjusted after-tax income. Now, it takes even more of the student's income above a certain amount. Beyond your income, they're actually adding back to your income whatever you took out in that prior year into retirement and health savings accounts. So any kind of income that you tried to shield from taxes, they will recalculate it and put it back into your income, but only for the year that you're filing. So, your retirement that you put aside 10 years ago, 5 years ago is not relevant. That is excluded. It's just in that year that you're showing your income for. In addition to your income, they do take a percentage of parents' assets as well as a higher percentage of the students' assets. The good news, if there is any here, is they are excluding home equity, and they do exclude your retirement assets as well as your non-qualified annuities. So just to give you an example to see just how much they penalize income. have an example here of a family that has $150,000 after-tax income and no assets. They've never managed to save. And yet their EFC is almost full pay. Their EFC is $70,500, which means, again, any school that costs $70,000 or less, they're expected to pay the full amount. On the other hand, let's take the other extreme, a family with no income and $1 million sitting in the bank, and they're just living off of that. They are only expected to pay $56,000. So again, it's showing you just how much your income is a factor, and honestly, how little you can control it, because most people don't want to decrease their income in order to get more financial aid. So beyond the government calculation, as I mentioned, there is the institutional calculation. There are about 4,000 colleges across the country, and only 400 use this particular calculation. However, they tend to be the more popular, and very often the private universities will use what's called the CSS. The CSS is related to the College Board. So if you guys have dealt at all with the SAT or PSAT or AP exams, that all comes from the College Board. This formula is much more comprehensive. Now, the formula will actually vary from university to university. The big difference is, first of all, they do account for your home equity. Then other than that, they also account for businesses that are a little bit just different calculations from the way it's done in the federal calculation. For parents that are separated or divorced, the federal calculation to date has only included the parent that the kid lives with more. And so then the CSS asks for both parents' financial information. And then there's some other expenses that, sometimes their calculation can actually be lower than the EFC. For the most part, though, most of the families I've seen, the institutional one tends to be even higher. And that is, again, because around here, people tend to have a lot of money tied up in their home equity. The best way to find your institutional EFC is, again, on that net price calculator on each university's website. So I just want to give you an example. It's a bit of an extreme example, but as we're comparing colleges, so College A and College B, if you just look at their cost of attendance, again, the sticker price, without a doubt, College B is cheaper, right? It costs $25,000 instead of $50,000. However, this family needs a lot of assistance. This family has a low EFC of $10,000. So their need, again, is the cost of attendance less their EFC. Their need here is great at $40,000. Their need in the other school is lower. But here's where there's a big difference. College A has a big endowment. College A will meet 100% of that need. Therefore, at the end of the day, College A is only costing the family their EFC of $10,000. College B, on the other hand, doesn't have a big endowment and is only meeting 50% of their need. So in addition to their EFC of $10,000, the family has this differential, this $7,500 to make up. And at the end of the day, College B costs this family more. So what I'm trying to show you here is that you can't rule out schools based on just their sticker price. Because if you did that, then obviously your list would look like College B all over the place. But at the end of the day, College A could cost you significantly less. Now, this is what makes it also tricky, because you can see sticker prices. But in order to actually find out what the college costs you, you have to know a lot more detail about the percentage of need met, how they meet the need, again, grants versus loans, and what are the chances that your family will get the need. So you'll have to understand financial aid as well as merit aid, which is, I will get to merit aid in a second. I forgot I wanted to cover the loans versus grants first. This is the scary part. Student loan debt is all over the news lately. It has ballooned, and we are now at over $1.5 billion worth of student loan debt. And, there's been some talk of maybe forgiving some of it. I don't know. We don't know what's going to happen. We don't know which part or how long that's going to take. In the meantime, it's just been growing and growing. And to me, the scariest part is if you look at the color coding, look at what's grown in the older population. This is, in the gray part, it's people in their 50s, and in the orange is 60s and above. These are parents and grandparents that are taking out student loans for their kids. To me, this is actually quite scary. I have read just horror stories about, elderly people whose Social Security checks are garnished because they haven't made the student loan payments. So it's definitely something to be very careful about. In general, when it comes to taking on student loans, there's a little bit that might be beneficial. I often tell my families that, every American student is entitled to take $5,500 of loans the first year, and then it grows every year so that you have a total of about $27,000 over an undergrad degree. That is usually the max of what I would recommend. And even if you don't need the financial aid, you might want to take it out for two reasons. One, it gives your student some skin in the game because they don't oversleep and go to class or miss their class when they know that they have to pay some loans at the end of the day. The other thing is that taking out loans starts a credit history for your kid. So there is a benefit to a small amount of loan. The problem becomes the large amounts that really kind of weigh people down. And we kind of have a rule of thumb that your maximum loan should be your first year's expected income. So if you're studying to be a teacher and you have an expected first year income of $35,000, it's going to look really different than if you're studying computer science and you're going to expect a starting income of $90,000. You have a lot more wiggle room to take on loans. Innessa will get really into the details about whether or not you want to do loans or save money. In general, loans are something that we do want to try to avoid as much as possible. Again, by trying to build the right college list. So in addition to financial aid, I forgot about this part. The changes coming. This is the kind of unexpected. This was snuck in at the end of December in the big COVID relief bill. They snuck in a FAFSA Simplification Act. This was something that had been building for a long time, and they just somehow attached this to that bill. It was just recently passed, so we still don't know too much about it. But the good news is it doesn't take effect for about another year and a half. So for this coming year, if you have a current senior or if you have a kid in college already, you will still file financial aid the way that you have in the past. It's for those students that are currently sophomores, everything is about to change. So first of all, some of it is just the naming of it. The EFC will now be changed and called a student aid index. Some of the calculations will be somewhat different. In this, there are some good things for overall. Government is now requiring that every college will put the itemized cost of attendance on their website. It has been very difficult to compare apples to apples when one school is only showing you part of the cost and the other is giving you a lot more detail. The other thing that's been helpful here is in this part about increasing the income protection allowance. Remember how in students, the first $6,000 that they make was excluded from income. That will grow. Also, the amount that the parents' income will grow. So that is good news. Some bad news for families that are divorced or separated. They were kind of able to play with this. So if the families are really 50-50, they were able to play with it so that the parent who earns less could claim that the kid was there, that just a little bit more. That's going to change. And now the parent who provides more financial support is the one who's going to have to report. Some other good news, on the other hand, is that if their grandparents set money aside for the kid, until now and through next year, that is considered untaxed income for the student and has harmed their chances of getting financial aid. That will now be excluded from the calculations. So grandparents can go ahead and fund as much as they want going forward after this next year. And finally, this change, depending on what side of the aisle you stand on here, if your kids were spaced very far apart, you will be thankful for this. If your kids were, very close together, this will hurt you. It has been that there was a benefit to having kids in college simultaneously. So if you had twins or triplets, or you had kids who, 1 year after another, they would take your EFC and then just divide it by the number of kids that were in school simultaneously. So that was really a benefit for families whose kids were not spaced apart. Now they're changing that, and they kind of figure that was an unfair advantage to families that had spaced their not far apart, and penalizing those that had, when there's really no right or wrong there, like no right way to balance your, how you have your children. And that basically, if you have 2 kids, you need to pay for 2 kids. And if you have 3 kids, you have to pay for 3 kids. So that will be changing. So I've talked a lot about financial aid. Let's talk a little bit about merit aid. They are different concepts. Sometimes there is a bit of a link between them. For the most part, they are quite different. Merit aid is just really how much the university wants to give you to kind of lure your student to come. And there can be a variety of reasons that they do this. It could be that your student's GPA in high school was really high and they want somebody with that academic rigor in their school. Could be your PSAT score. It could be that your kid is applying to a particular major that they want to grow. It could be a talent that they had, for instance, if they're being recruited for a sport, or if they are a musician or any kind of dance, any kind of performing arts. Some universities, they automatically award merit. So when you get your offer letter, that you get your acceptance letter and they say, okay, here also we want to give you $10,000 a year or whatever it is. At other universities, you need to actually apply for it. It is quite common that they have some strings attached. That, for instance, you may need a minimum GPA of 3.0 or 3.5, whatever it is. If you are a recruited athlete, you need to maintain your sports eligibility. For the most part, merit aid is not linked to financial aid. So families who don't qualify for financial aid can still get merit aid at many places. In some places, they are linked and they will prefer to give the merit aid to those families that have financial aid. That tends to be the case more at schools that cannot meet full need. So they can't help them from the financial bucket. They might be able to help them more from the merit aid bucket. And finally, when you're building your college list, if cost is a factor, you might want to consider looking outside the US. Outside of this country, college costs a lot less. The other advantage is that in many countries, an undergrad degree takes only 3 years instead of 4. So you've saved 25% off the bat. I have a few examples here. Canada, for instance, these prices are all for an American citizen. Okay, so if you're a Canadian, even better. But for an American looking abroad, in Canada, it tends to run about 30 to 60,000 all in. Again, room and board, tuition, fees, everything. That wide variety there between 30 to 60 is interestingly very much dependent on the major. In the US, we don't tend to do that. In the US, we tend to have one price at a university. Outside the US, it is very much dependent on the major, where there are majors that are more resource intensive, like engineering and sciences, that tend to be more expensive. And your social studies kind of subjects tend to be on the lower end. The other reason for the wide variety is also just the university and the location. Those that you tend to be in big cities tend to cost more. In the UK, we have, again, a kind of a range, not quite as wide. And here the big difference is that in England, it is only 3 years to do your degree. Scotland is like us in the US, they're 4 years. As they like to say, we are like them because we imitated their system. But in England, it is only 3 years. And the upper end there, that 64,000, is for your really elite schools like Cambridge and Oxford. So if you take that times 3 years, you're looking at about $196,000 for a very elite degree, where in the US at a comparable school would run about $320,000. So there is a significant savings to go abroad. Europe actually has some countries that are absolutely free as far as tuition, even for Americans. And so that's why you have such a low number on the low end. That is just your room and board. And again, in continental Europe, most undergrad degrees tend to be 3 years. All that said, there are some additional costs looking overseas. In particular, you have currency risk, so you don't know, all these rates that I've given you in dollars are the most current exchange rates. They could obviously fluctuate quite a bit. You have the added cost of international flights as well as student visas and other expenses. So I will turn it over to Innessa in just a second. I just want to leave you with my contact information. Feel free to take a screenshot. And I know that Matt will be sending you a resource list later with our contact information. I will stop sharing, and Innessa, there you go. Over to you.
Okay, I'm going to take over this sharing. Thank you so much, Sharon. That was so much fantastic information. I know it's a lot to digest, so rest assured we will save time for questions at the end. And you can go ahead and type your questions into the chat at any time. So just as things are occurring to you as they go. So I'm going to talk about college savings. So kind of the Sharon laid out the costs, and there's some scary numbers there, unfortunately, and scary growth in those numbers. But I'm going to talk about what strategies you can use to try to save and invest to pay for those costs later on. So normally when Sharon gives her presentation, she's talking to families with high school students. I think middle school students she works with as well. But we sort of have geared our presentation to be applicable to families with younger children, or even grandparents, if there are any grandparents in the audience looking to help out. So we'll try to kind of cover that as well if there's specific questions. Okay, so I'm going to turn to my first slide. Sorry, my computer's being a little slow. Try again. There we go. Okay, so this is the typical financial planner type of slide. And what this is showing you is that it is definitely worthwhile to start saving as early as possible. And if you start saving as early as possible, you're going to take advantage of the magic of compounded interest. So you're going to be able to make money on the money that your money made. And so that's great. But I also want to hit on the point that it is never too late to start saving. So the best time to start saving, if you haven't started yet, the best time, and you have a student that will be going to college, the best time to start saving is today, today or tomorrow. So start as soon as possible. And the earlier you start, that magic of compounding interest really does help in your favor. So as you can see here, if you started saving when your child is in a kindergartner, you're going to save kind of 5 times or so more than you would if you waited until 9th grade. So start saving. And then in terms of saving, sort of what are some ideas to get started? Where are you going to take this magic money from that you're going to put into these savings accounts? So there's several different strategies that you can use, and there's just some ideas that I wanted to lay out for you. One is that you could start with a set monthly contribution, and that could be, as little as $25 a month at the beginning, and maybe ramp up over time. But just, even if it's small, start as soon as possible. The second is maybe there's movements in your life where you have more that you can save. So one typical trigger point is if your child is in daycare or full-time preschool and they transition to kindergarten, there is usually some child care savings at that point. So you can go ahead and bank that money or go ahead and save that money. You can also say to yourself, okay, I can only afford to contribute, $50 a month or $25 a month now, but any of my future salary raises, I'm going to take 10 or 20% of that, and I'm going to also use that to save more money. So that's another strategy that you can think about. Any lump sums, such as inheritances that you come across, that can be a source of savings as well. And then you can think creatively. So I worked with a family once who actually purchased a vacation home, and when their child was young, and their strategy was they were going to pay off that vacation home over 10 years. And then by the time their child graduated from college, they were going to sell the vacation home and use that as their source of financing. That's a little risky because college costs grow at one rate and real estate might appreciate at a totally different rate, and it might be lower. So I'm not necessarily advising that, but you can think creatively as well. And then you can also think about perhaps grandparent support. Maybe instead of birthday presents or Christmas presents, if you think that money is going to be tight for college, maybe you approach grandparents or other family members that like to give presents to your child and say, well, I just really appreciate if you took that $20 and you put it aside for later on. Again, even small amounts can grow and be helpful over time. So those are just some ideas. So let's talk about where to save. So where to place that savings. And I'm going to kind of do this in reverse order because I think the 3 at the bottom are kind of easy to go over. So these are CDs, saving bonds, UTMAs, or custodial accounts, as they're often called, are definitely very safe investments in terms of places to save your money. So they're safe. They're going to protect your principal. Your principal's not going away. But the rate of return, the interest that you're earning on these accounts are extremely low in the current interest rate environment. And so is not going to keep pace with the inflation costs of college. So these are not advisable places to save if your goal is to grow your money at the same pace that college costs are growing. If your goal, though, is to protect your principal, these can be some good choices to look into. I just have to move my video window. Okay, so the next one over here is just your after-tax investment account. So that's like your typical brokerage account. So you can take money that you've been saving from there to pay for college costs. You're not going to be getting any special tax advantages, however. So this is an option, but there are probably some better options out there. Another option are IRAs, so individual retirement accounts. So IRAs, normally if you withdraw money from them and you are younger than 59 and a half, you will be assessed a 10% penalty. However, if you are withdrawing funds to pay for qualified educational expenses, you are not hit with that 10% penalty. So there are things called education IRAs, or Coverdale IRAs is the other name that they've gone by before, and Roth IRAs. These are IRAs that are funded with after-tax dollars, but they grow without being taxed. So any growth on the income that you're earning in these IRAs are not taxed. However, contributions into these types of IRAs are limited by your income. So if you earn more than, I think it's 160,000, maybe 180,000 in the case of a Roth, or more, and you're married filing jointly, you cannot contribute. So these are not going to be options for you. And then I would go on to say, I intentionally did not place a traditional IRA here as an option, because although you can withdraw from traditional IRAs, and one study I came across showed that 14% of families are using traditional IRAs to help fund college costs. It's really not advisable because you're taking from your retirement. So sort of one quick way of looking at it is that even if you want to try to minimize student loans for your student, and we talked about, the reasons that you don't want to cripple your child with really high student loans. At the same time, your student will be able to get a loan. There are things called student loans. And unfortunately, there's not a bank that's going to give you a loan to retire. No bank is going to pay you or loan you money for retirement. So you do need to make sure that you're on track for your retirement savings. But Roth IRAs and educational IRAs might be a source of where you can save. And then kind of the two more popular options and ones that financial planners typically recommend are 529 plans and prepaid tuition plans. Of the two, 529 plans are typically more popular. They offer a little bit more, they definitely offer more flexibility. Both of these 529 plans and prepaid tuition plans are administered on a state level. So they kind of abide by state law, and they're state specific. So we'll go ahead and talk about what these look like in Massachusetts. So Massachusetts offers two different plans. Their 529 plan is called the U Fund. It's administered by Fidelity Investments. There's no minimum investment, so you can start with a really low monthly contribution. You have investment choices, so the money that you invest is an investment. It is invested in the stock and bond market, so it's invested in securities. And you do have some choice in terms of your investment allocation. But if that seems difficult or challenging for you to figure out, you can also utilize a target date fund. So that basically means that you select the year that your child begins college, and Fidelity will automatically balance your portfolio between stocks and bonds, leaning more towards stocks when your child is younger and you have a longer term investment horizon, and then allocating more towards bonds, so investments that fluctuate less as your child is closer to college, to try to protect the money that's saved there. You're going to have tax-free growth in a 529 plan, and it will be tax-free when you take the funds out, as long as they're used for qualifying educational expenses. You can always change the beneficiary on these accounts. So if your child does not go to college for a reason, or you don't use all the funds in the account that you have saved, you can transfer to another beneficiary, another child, a grandchild, a niece and nephew. There's quite a bit of flexibility. It does have to be a family member, and I think the IRS defines it as a family member related to you by blood, marriage, or adoption. So there does have to be some kind of family relationship, though. You can cash out the funds, but you will be charged a 10% penalty, and you will have to pay taxes when you take the funds out if you're not using those to pay college costs. Fairly recently, also you can use funds in a 529 plans to pay for educational expenses that are not college, that are elementary school, private elementary school, and private high school, and private middle school, so private K through 12. And that's limited to $10,000. So there's some flexibility with education. It's not just college. And it also, you can use the funds for graduate schools as well. Oops, I didn't mean to flip quite so fast. So the other last point on this is that you are welcome to invest in any other state 529 plan. But if you're not investing in the Massachusetts plan and you are a Massachusetts resident, if you're not investing in the Massachusetts plan and you are a Massachusetts resident, if you're investing in another state's 529 plan, you're not going to be able to take advantage of the Massachusetts income tax deduction. So you just lose out a little bit there in terms of tax deductions. So that's a lot of information. Okay, so now we'll transition to the next slide. Again, a lot of information. So this is the Massachusetts prepaid tuition plan, and they call this one the U plan. There is a minimum, but it's fairly modest, of $300 to open. The money is not invested in the market, but it is backed by the state. So as long as the state of Massachusetts is solvent, your money is safe and will be used for this purpose. It can be used as at over 70 schools in Massachusetts. I took a quick look at the list. It doesn't cover Harvard or MIT, but it does cover a real wide range of schools. I think Tufts is on there. I think Boston College and Boston University are both on there. The list is available on a website that I'll reference at the end of these slides so that you can take a look. And basically, the way these plans work is that you purchase an amount of a year of college in today's dollars. So what you're doing is you're taking away that risk of college cost inflation. So you're removing that as a risk factor. So let's say you have enough money to pay today for 1 year of University of Massachusetts. So you pay for that today, and you can be assured that that will pay for 1 year to go to University of Massachusetts in the future when your student reaches the age of 18 or their first year of college. There is a little bit of flexibility. You can change beneficiaries of this plan, and you can also cash out the funds. So you can take your principal back out. That's tax-free if you're a Massachusetts resident, and you will be able to take out your principal plus a rate of return that's set at the consumer price interest. So you do have a little bit of flexibility there. These prepaid tuition plans tend to be less popular than the 529 plans, though, because they are more restricted. You do have to, if you're not going to cash them out, you do have to use them at one of those 70 schools. Okay, so this is just talking about loans for a minute. So I know Sharon went over this already, and I think that her point is right on. You don't want to burden your student with outsized loans for sure, but there can be reasons why it makes sense to take out a little bit of loan money. And there's several different flavors of different loans. And I don't know, Sharon, if you're able to kind of comment on the 3 different types. I know you're the expert in this area.
I'm still here, yeah. So your federal student loans, the current interest rate is 2.75%. That will change on July 1st. It changes every year on July 1st. They definitely tend to be lower rates than private loans. So if you are going to take loans, then the federal loans are generally the way to go. There's a difference between subsidized and unsubsidized. As I mentioned, every American student can take $5,500 in the first year, then it grows to $6,500 the next 2 years, and $6,500 then $7,500, for a total of $27,000 for undergrad. Those are the unsubsidized. So that is regardless of your financial situation. Subsidized loans are for those families that qualify for financial aid, and at certain levels. There's different types of grants depending on what your income looks like. Subsidized just basically means that it doesn't start to accrue interest until after you graduate. But the unsubsidized is the loans that most people take, that does accrue interest from the very moment you take it. The amount of your loan will be awarded to you in your offer letter from the colleges. Again, there is the $5,500 that everybody can take, and then depending on what your financial aid form package looks like, there might be more. Parent plus loans, that's the part that kind of scares me that I showed you from that debt. That is usually something I would try to avoid. Those interest rates tend to be high, and the bigger problem is that there's no collateral behind it. You're not even the one going to college. You're not the one who's going to have a starting salary that depends on which college you go to here. And I have just seen really, really sad stories of what happens when parents take out these loans. I am not a financial advisor. That falls on Innessa and those kinds of CFPs. But in general, you might want to look at a home equity line of credit before you take one of those loans. And then I'd say the same thing about private loans. I would try to steer clear of both the parent and the private as much as possible and go with the federal loans. And now you have the added bonus of those federal loans might be forgiven. So who knows? We have no idea what's going to happen there, but that certainly doesn't look like it would happen in the private sector.
Mm-hmm. Great. So thank you, Sharon, for commenting on that. Yeah, loans are definitely tricky, and the financial planner in me has to reinforce that point that you're not going to find a bank to give you money, to loan you money for your retirement. Unfortunately, you can take out loans against assets. So if you have if you have built up home equity and want to take out a loan against your house, that's an option. But a bank is not going to loan you money for your own retirement. So so you want to be careful with the money that you take out as a parent. Definitely tricky issues. Okay, so one more slide before we close things out and open it up to questions. And this is on tax benefits. So probably when you've done your taxes or you've had your tax preparer do your taxes, there might have been mention of different educational credits and deductions out there. And yes, they exist. I think the bad news is that they are limited by income. They tend to phase out, I believe it's around $120,000 married filing jointly for the lifetime learning credit, $180 for the American Opportunity Credit, and I believe the tuition and fees deduction is somewhere in the middle. But if you're earning less than that, so if you earn less than $180,000 married filing jointly, or I think it's $90,000 if you're filing singly, you do want to investigate which of these credits and deductions you may be eligible for. If you are eligible for all three, you should know you can only take one, so you can't double dip or triple dip for sure. So it's one of these American Opportunity Credit, Lifetime Learning Credit, or tuition and fee deductions. It's not all three. If you do have the choice between all three, the American Opportunity Credit is the one that's slightly better because it's a refund. It's slightly higher, first of all, and it's also a refundable credit, meaning that at the end of the day, if you do your taxes and you are owed money because of this credit, the government will actually write you a check for the balance. So this is the better one. But if you're not eligible for this one, and you are eligible for the lifetime learning credit and the tuition and fee deduction, of these two, the lifetime learning credit is typically the better one. Credits are typically better than deduction. So a credit is a dollar for dollar offset against your taxes, whereas deduction is reduces the income that then you pay taxes on. So that's kind of the takeaway here. And then the student loan interest deduction, that's another one that's available for you. It's also available for parents, or for the student as well as the parent, whoever is obligated on the loan to take. But again, that is phased out at certain income limits. And another thing just to point out here is that if your student has earned income of their own and is eligible to file their own tax return, you might want to look at what their tax situation would be if they filed on their own, even if you can claim them as a dependent. So you lose the dependent credit that you're getting, but your child, because of these educational credits, might end up in a better tax situation. So if you are using tax software, you can run those two analyses, or if you use a tax preparer, you could ask them to take a look at both of those scenarios and see if there's any help available there. But I guess the upshot of this is that as of right now, there's unfortunately not a lot of government help out there to fund colleges. There's some buzz in Washington right now about how that might be changing, either with student loan forgiveness, or I think the latest proposal that I heard about is that there is a proposal out there for free community college, but that's certainly nothing that's in law right now. So we'll kind of have to wait and see. Okay, so I think the last thing we wanted to do is just leave you with a list of resources. Matt has this information as a one-pager, along with Sharon's contact information, my contact information as well, and he'll go ahead and send that out to everybody, I believe probably sometime tomorrow. So you don't have to feel like you have to write everything down, although you feel free to take a quick snapshot of the screen if you want. What we listed out here first is the mefa.org/save website. So they're the ones that administer and provide information about the U Plan, which is the prepaid tuition plan in Massachusetts, and the U Fund, which is the 529 college savings plan. So they have a lot of information about those two programs. They also have an expected family contribution calculator, and they have a whole lot more. They have videos and podcasts and articles. So however you like to digest your information, they have really great, accessible, easy to understand information out there about college costs and college savings. As Sharon mentioned, the net price calculator is extremely important, and that's on each college website. If you are interested in looking at more information about student loans, studentaid.gov is a great resource. Saving for College is a great resource as well. On the savings side, they have a nice tool for comparing some of those saving options, a 529 plan versus a prepaid tuition plan versus CDs or a savings bond, and might help you narrow out some choice there if you're currently deciding about where to save. And then if you wanted some more information about taxes, the IRS has a lot of great resources and articles, and there's a link there that takes you to some information. And then lastly, Sharon and I both read this book recently, written by Ron Lieber, who is a New York Times columnist. And I think for Sharon, it kind of just is a reflection of everything she already knows. For me, when I read it, it was really eye-opening, because it's been 30 years since I went to college, and things have changed dramatically in those 30 years. So I thought it was just extremely informative, and also very readable as well. So if you're looking for a book recommendation to learn more about the process of applying to college, merit aid, financial aid, how all that's working, that's a really, really great resource. And I did a quick check, Matt, right before this, and this is available through Cary Library, through the Minuteman Network. There is a bit of a hold time, but it is a book that you could put in a request for through the library. So I think that ends our formal presentation. So I'm going to stop sharing my screen.
Thank you, both of you. We do have some questions in the chat.
Fantastic.
So the first one, Sharon, I believe that you answered this, but I'll just ask it again just so people can hear it. If someone has already filed a FAFSA, is there a way to look up the precise EFC rather than re-entering all the info on the website?
Yes. So once you file the FAFSA, you actually get confirmation and you get a letter that details what your actual EFC is, because the other website that I was talking about, that's your estimate. Once you file your FAFSA, there's actually a number that comes back to you. And then as far as what the colleges consider, so that is your federal EFC. You don't actually know the college calculation until you get the financial aid award letter. So once your student is accepted, then they send you a financial aid letter.
Next question is it better to save money in a regular bank account, or is a 529 better, and which will grow faster? I'm sorry if you did answer that, but if you just want to clarify.
Oh, no, yeah, happy to do that. This is where things get, it can get complicated, and there's unfortunately, there's no definitive answer. So if you're saving money in a bank account, you are going to be earning a very low rate of return, a very low interest rate, because the interest rate inflation has been very low here in the U.S. for decades now almost, and so banks are paying very low interest rates on savings accounts. So you're not going to earn a whole lot of money if you're saving in a bank account. And the rate of college costs has been skyrocketing. I think, is it 7% a year? Is it above 7%?
It will depend on the university, but often it's about 5%. It is very high. This is the first year that, because of the pandemic, that some colleges actually rolled back their tuition, and that's because they realized that Zoom school isn't worth the same amount. But unfortunately, it was a really small percentage of schools that did that. Most even went through and still raised their tuition. So
those are the stories that I heard of colleges raising their tuition, the typical 3 or 5% that they normally do.
Yeah.
And so the interest rate that you're going to get from your bank is going to be much less than that. It's going to be, more akin to like 1%, sometimes a little less, sometimes a little more, but it's going to be much less than the rate that college costs are growing at. Okay, so 529 plan. So the funds in a 529 plan are invested in the stock market. It's invested in you can choose between stocks and bonds. So you have some investment choices. You can invest in things that are a little bit more conservative. I believe, I'm not entirely sure with the Fidelity 529 plan, but usually there should be a money market option. Money market funds are relatively safe. So that's but again, not a high rate of return, so a low rate of return. So if you want that high rate of return that you hope is going to keep pace with the cost that college is increasing every year, then you are going to want to look at a 529 plan. Now, the unfortunate news is, because that fund is invested in the market, like any investment, there is the chance that that is going to lose its value, that you're going to see a market dip, or even sometimes a market crash, and that value of your 529 plan is going to plunge. And I think this past year, in 2020, last March, when the market had a very sizable correction, I think there were a lot of parents whose kids were due to go to college right around the time that those deposit checks are being asked for, and the 529 plan balance was not what they had expected. So the market has recovered since then. It's now extremely healthy, which makes some people nervous, but it has recovered, but that is no guarantee. So I hate not to have a definitive answer, but it does depend on your level of appetite for risk. And you should definitely understand that if you are saving in a bank account, the risk is not that the principal will disappear. So if you put $100 in, you're going to still have that $100, and that's backed by FDIC insurance, so it's going to be there. But that $100 is not going to go very far given the rate of inflation of college costs.
The next question is, how can grandparents contribute to a 529 on a staggered basis?
That's a great question. So there are a couple ways to do it. So one is 529 plans. Again, I would have to check with the Fidelity plan, but they can typically accept third-party contributions. So a grandparent could, if their grandchild already was a beneficiary of a 529 plan, the grandparent could make a contribution into that 529 plan. A grandparent could also set up their own separate 529 plan for a grandchild. You do have to have one beneficiary. So if you have multiple grandchildren, you would need to have multiple 529 plans. So you couldn't just have 5 grandchildren as beneficiaries under one 529 plan. You'd have to have 5 plans for them. But that is an option as well.
And I think that this one was answered in the chat, but I'll just say it again for so everyone can see. Can you use a 529 for international colleges?
So that depends on whether or not that university accepts the FAFSA. The FAFSA is the free application for federal student aid. That's the federal student aid loans. Most UK and Canadian universities do take the FAFSA, and so then you can also use the 529, but you definitely have to check per university. It is quite rare in other countries for them to take the FAFSA or the 529.
What is the impact of U-Fund on financial aid?
That is a good question, Innessa. I don't know if you know the answer to that one.
I don't. Can you repeat I missed one key word.
What is the impact of U-Fund on financial aid?
Okay. I believe it's looked at in the same way that a 529 plan would be looked at, as an asset. I would think that they would value it based on the principal, and then with the same CPI rate of return that you'd get when you cash it out. You have to, I'm not 100% certain, but I think that's how they look at it. It would be an asset.
Can you have multiple 529 plans for the same child with in-state and outside state?
Yes, you could. There's probably some benefit, like if you're the owner of both plans, there's probably some benefit to consolidating them because 529 plans do charge fees. Typically, the fees are kind of embedded into the plan itself, so they're kind of a little bit hidden. So I would think that you might want to look into consolidating them, but you can have as many 529 plans as you want.
The next question is, when is the right time to liquidate your 529?
So typically, you would withdraw money from your 529 plan to pay for college once your child begins college, but you wouldn't liquidate it all at once. So let's say you've managed to save $100,000 in a 529 plan, and you might want to try to use $25,000 in year 1, $25,000 in year 2, $25,000 in year 3, $25,000 in year 4, kind of phase it out. You wouldn't want to liquidate it until I would think until your child is done with college, because then that allows it to grow a little bit more by staying there.
And the last question that's come in is the 529 plan set up by the grandparent transferable to another grandchild in the same family, similar to a regular 529?
Yes. Yeah, so the 529 plan that a grandparent would open and a parent would open would be the same exact plan. So you can change the beneficiary. So you could set it up in the name of one grandchild. If there's money left over, or you've decided to allocate that to another grandchild, you can just simply change the beneficiary's name on the account.
Well, there's one more that came in. Can unused money from 529s be included in estate planning?
So if you have unused funds in a 529 plan and there's no other child that you want to name as a beneficiary, or you don't want to wait to see if your child has a grandchild and maybe name that grandchild as beneficiary, you can at that stage cash out the 529 plan and close it, but you will be hit with a 10% penalty. So if the
Yeah.
money is not being used for qualified educational expenses. I've seen some situations where people use that for, for going back to school themselves in later life. You could take even a part-time, community college course or a life enrichment course. You could use a 529 plan to pay for that.
I think that's a good point, Innessa, that the 529 is not just for undergrad. You can keep the money in there and use it later if your kid goes back for graduate school, for instance.
Yes, and you could use it for yourself. You could use it for yourself. You could use it for a nephew or a niece. There's flexibility as long as it's being used for a family member.
There was two more that just came in. Sorry, because I keep saying it's the last question, but 10%, somebody asked, is it 10% on the earnings, not the principal?
It is 10% on, yes, that is correct. It's 10% on the earnings. Yes, which can be significant if you began the 529 plan early on.
And is there a limit on unused money sorry, let me say it again. Is there a limit on unused money in the 529 plan if transferred from child to grandchild?
No, there's no limit. There is usually a plan does have a maximum amount that can be held in the plan. It's pretty high. It's like 300,000 or 350 or 400,000, somewhere up there. So there does tend to be that maximum, but there's no as long as you're under that threshold and you're changing the beneficiary, no, there's no limitation. And I should say that threshold is on the contributions and not on the growth. So let's say that you managed to save the 400,000 and so you can't contribute anymore, but that 400,000 will keep growing. I mean, that's from a financial planning standpoint, I would say that that's probably over saving at that point, that you don't need to save more than $400,000 in a 529 plan.
And is there a limit on the annual contribution to a 529?
So there is no limit. However, if you are contributing more than $15,000 in any one year, or utilizing this rule that they have where you can contribute $75,000 one time in 5 years, if you contribute over those amounts, then you will have to file a gift tax form. So a gift tax form does not actually mean that you're paying any taxes in that year. So you're not paying gift taxes. What you're doing is that you're notifying the government that you've contributed over that amount, and that amount over is going to be deducted from the amount that your estate is exempted for estate tax purposes when you pass. So there's a filing notice, but there's no restriction. Other than the maximum amount that the 529 plan has on total contributions, that $300,000 or $400,000.
All right. Well, thank you, Innessa and Sharon, for providing such great info. Sorry, there's a notification just popped up. For providing all this information for all of us. This program was recorded and will be on the Cary Library YouTube page by tomorrow, so you can rewatch it. And we will also be sending out the one sheet that Innessa and Sharon provided that has some of this information as well as contact information. So thank you again for everyone attending, and thank you, Innessa and Sharon. We also have a bunch of thank yous coming in the chat.
Great. Well, thanks for having us.
Yes, definitely. Thanks for having us. Thanks for letting us talk. I'm always happy to talk about financial planning.
And I can always talk about college.